Folks, welcome to Code and Concrete, where we share the latest trends and the stories of trailblazers in the built environment. We hope you gain some insight from our wide range of topics, such as real estate development and sustainability, or blockchain, artificial intelligence, and data. Joining us today is Ryan Munn and Scott M. Graves. Ryan is a dynamic strategist and innovator with over a decade of experience navigating the intersections of multi-sector collaboration and deep technology. With a strong foundation in infrastructure, emerging technologies, and software as a service, Ryan excels at bridging complex technical concepts with actionable strategies that drive impactful outcomes for organizations and communities alike. Scott provides expertise in management, fund development, and strategy for real estate development. He's currently a lead for developing senior living properties in Wisconsin and Massachusetts under the brands Heartland America. He's got $157 million in construction project budgets under management and leads in developing a national equity investment opportunity with a novel faith-sponsored strategy. Under the brand Living Local 413, Scott manages a team of developing mixed-use properties targeting tech and tech-enabled entrepreneurs, coupled with amenities such as venture capital and accelerator programming. And you've also developed 4 incubator programs for clients and employers. Is that right, Scott?
That is correct.
Great. Well, both of you you gave me a mouthful to present. You've got great backgrounds, a lot of projects going on, and I'm excited to dive into this. We just wrapped up recording a podcast, the 3 of us talking about blockchain and real estate development, and now we get to dive into what you guys are working on instead of me being interviewed. And so thanks for being here.
It's an absolute pleasure to be here talking with you and doing this. What is this? The Great Monday Night Podcast Exchange 2025.
Yeah. 2 hours in the making.
A bit of a marathon, but we appreciate it. Really appreciate having you on and really excited to hear what you have to ask and answer your questions.
Yeah, well, Code and Concrete really likes to focus on the real estate development side of things and extracting expertise from that. I mean, it's in the name. What technologies are being applied? What practices? What's been gathered from years of experience that other people could apply? And so as opposed to interviewing you, the way that I've been interviewed, a lot of it comes down to that practical on-the-site knowledge. Like, we encountered a problem, we solved it this way. And I think both of you have a lot of expertise in your general areas that people are going to be able to walk away with something, apply it to their business, and become better at their business as a result.
Well, I appreciate that confidence.
Of course. That being said, I have to admit this is a special episode for Code and Concrete. It's one of the first times that we've had multiple speakers on. So I don't want to play favorites, but in order of the introductions that I was given, I'm going to start with Ryan. And Ryan, we've talked about captive insurance and blockchain technologies and enterprise use cases for blockchain in healthcare. But one of the things that really interests me, because it's an interest of building, is the insurance area. And so what I want to do, because I always like to get to know our speakers a little bit, is can you give us sort of like a timeline, a recap of how you got into the captive insurance industry, if it could be considered that, and then why we started talking about its potential use in blockchain?
Yeah, absolutely. Thank you for the question. It's been an interesting adventure. Initially, I sort of was making my own way professionally and had discovered Bitcoin. And years after that discovery, really started looking for more of a professional outlet for that, and got involved with the legislation in the state of Vermont. And that legislation was written up and submitted in 2017 and eventually passed in 2018. And that was about establishing a blockchain-based limited liability corporation and sort of opening up the ideals of the structure of business management using blockchain. We covered a little bit about personal data protection, and that was sort of a start, but it was just an enabling statute. What was really interesting to me was that I found in that process, sort of part of the cohort, were companies and individuals involved with captive insurance. At the time, I didn't really know anything about that, but I've come to learn that captive insurance is a sector that uniquely serves self-sovereign insurance. It's very large, wealthy companies typically who self-insure, sometimes because they simply have the capital, and other times also because they operate in multiple jurisdictions. Think shipping companies. That's where really this industry kind of began. And it began, long before Vermont. But at the time that it came to Vermont, just prior to that, some laws were passed in Wyoming to explore the sector, to create a domicile there. And Vermont very quickly kind of followed suit, but then also funded an association. And really that helped get it kicked off as a professional endeavor for individuals and companies to start doing business in Vermont. And that was 40 years ago. So obviously I wasn't involved then, but about 7 years ago is when I started learning about this and started to recognize the intersection of blockchain as a disintermediating, risk mitigating technology, and where that really overlaid with what captive insurance does, which is instead of being a for-profit company like many insurances are, it's owned by the company who's insuring themselves. So sure, they're in business to make profit, but the real purpose of them having that insurance is to reduce the costs of insurance and essentially to mitigate the risks that insurance is trying to cover, because essentially they win when they don't have to pay a claim and they don't have a reason to pay a claim. And so that sector in Vermont really started to expand the applications and use cases for captive beyond just the shipping industry and started to cover all things that you can think of in insurance. And so, one way to think about it is it's the testing and proving ground of insurance concepts. Those things will get implemented inside of a captive that sort of generates the data and framework and sort of proves out the feasibility that was supposed around those models. And that enables the commercial market to then take that information and productize it into a commercial application. There is a small subset of captives that will serve groups, member groups or owner groups, or provide sort of sponsored models where a captive can be created and then smaller captives that are sort of cookie cutters can spin up. Because running a captive, at least initially starting one, is very expensive. There's a lot of work that goes into creating one, and it requires a lot of capital to backstop that captive in premiums and initial capital to ensure that you've given the regulators the confidence that you're going to be able to cover the potential losses that you want to insure. And so all of that has come full circle to me starting to learn much more about all different sectors. So just like blockchain kind of crosses all these different sectors, captive insurance crosses all kinds of sectors. And looking at captive as really, in my mind now, the sandbox for various applications and use cases for blockchain. And as along with blockchain, tokenization and smart contracts specifically, under the sort of legal terminology of parametric contracts, is where you can start to apply these mechanisms and bring them to market. So that's been a bit of an adventure and, very interesting sort of lots of reading and learning about different sectors and different kinds of insurances. But I think it's a big opportunity. And the other piece of this is that there's many domiciles in the world. I believe there's about 70 that domicile captive entities. But Vermont is considered by many to be the gold standard. It's the global leading domicile with around 300 billion in assets under management here, with a captive association that hosts a global conference in Vermont every summer. And it's one of the only state associations that has presence in Washington, D.C. So the laws here are often influencing the captive laws in other domiciles.
I see. And we'll dive into some of those concepts and definitions a little bit later, because I think captive insurance might be abstract for a lot of listeners. And we'll definitely want to hit on the crossroads of captive insurance and real estate, because I imagine that's a sector or an industry that stands to benefit from the proper rollouts of it. Now, I've got to ask, was captive insurance, was this a topic that you and Scott had first crossed paths on? And Scott, are you interested in captive insurance?
Well, the intersection there between Ryan and I, captive insurance, is that Brian and I started to have a dialogue talking about tech and tech-enabled business as an economic development instrument here in the state of Vermont. In its crudest form, the interest in captive insurance, and maybe I speak more for myself than the two of us, but I suspect to some extent I speak for the two of us. When you have an industry with assets on that order of $300 billion, particularly in a rural state that is also relatively poor, compared to other rural states, Vermont is maybe not so poor. But in the 6 New England states, it certainly has more poverty than others, states here in the Northeast. And so, and a some 90-year history of a relative disinvestment from the rest of the world in Vermont. And so when you have an industry that has that much assets under management, you have to think to yourself, well, that coupled with new, innovative, and interesting technologies, which generally produce jobs that are both well-paying and are also desirable for young people. Another issue for Vermont, our young have been leaving after college for a long period of time in bad numbers, and so how do we get all this to work together, with the end result being a more widespread, profitable economy for the state of Vermont? There it is. That was a long answer. I'm sorry, but it is the right one.
Right. I mean, the basis of economic stimulation, and I think both of what you work on, Scott, whether it's you in real estate developments and the driver of technology, or Ryan, the advocacy for captive technology, sounds like Vermont needs that. And I think, well, a lot of states stand to benefit. We were talking earlier about where a lot of capital and institutional capital is concentrated, and it's in very certain cities. And so it leaves a lot to be desired in other regions of the U.S. And it's unique opportunities like this, leveraging maybe larger markets and new technology to create almost a personality for those cities, the same way that Wyoming has attracted a lot of Web3 startups, because they said, well, we'll have friendlier regulations, so bring your startups here. Don't go in Delaware. And just leaning into an opportunity and making something out of that.
So you have a state that, like Wyoming, that did that, and that's an example related to tech companies. Montana, about a year ago, passed legislation, which in short is encouraging more widespread emerging developers to have the capacity to build the kind of housing that Montanans need, and really focused on that, that middle market for starter homes or for downsizing seniors. And, and here you have two examples of conservative states politically passing legislation to sort of, target the growth in two very important sectors, right? You need to have people that have the time and the money to spend on their neighbors, small business, doing work that's not only well-paying but is desirable to them, but they also need a place to live. Boy, is that existential, right?
Scott, I want to ask, because a lot of real estate developers don't think in the way that you've made yourself apparent here, where there's two foundations. It's the considerations of the community. What does the community need? How can we support them, as opposed to just driving for profit? And then leaning into technology adoption for whatever reasons, and you can describe those to us, why you do that. How did you develop this thesis or these principles as a real estate developer throughout your journey?
Mostly because my journey was non-traditional, let's say. I did not grow up in a family of builders. I did not go to school for project management or development work, or to work in the trades or anything like that. I came up as a performing artist, and academically, I went to school for music business. I worked in the industry for a compact disc maker back when we made mechanicals and didn't do just downloads, and artist management and that kind of thing. Was a touring musician myself, a writer and arranger, and had a full-time living for close to 20 years doing that. That, in short, led me to work in economic development, and that coupled with a personality towards problem solving, started to get into the development of effective programming that would be utilized in business incubators. And that got me into housing and interest in work in managing companies that build housing. Namely because all entrepreneurs, we see a need and we want to fulfill that need. And what I found was building business incubators in rural environments in particular, or deindustrialized urban environments, it's less about the interest in tech and tech-enabled solutions, right? You always had people young and old interested in starting businesses in those things. But unless those people have a place to live, they're not going to stay in your community, right? After you help them incubate a business. If you don't give them somehow access to the right kinds of financing, whether that's debt or equity at different stages of the business's growth, again, they may leave to go find that. Things like, and this is particular, especially in Western Massachusetts, Vermont, upstate New York, truly rural places, access to affordable childcare has been another major issue for tech and tech-enabled entrepreneurship, at least from the standpoint of, can I stay where I'm living, which is a desirable place, or do I have to go to a larger urban center, so that I have access to these things? And so what I found was it was bad for your pocketbook if you're trying to run, a downtown mixed-use development as an example, right? Your tenants are always leaving, and you thought that this incubator was going to help. Well, so you got to provide the housing. You got to provide. You don't yourself have to do all these things, mind you. You can get vendors to do it, but you've got to think about the ecosystem, right? And so that's how I ended. I don't want to say ended up doing what I'm doing right now. I absolutely love what I'm doing right now, but I came to it from a different place, not the traditional route.
So I like the comment on ecosystem, and I kind of want to dive into that just for a moment, because for prosperous, whether it's economic development or community development, thinking about ecosystem, I think a lot of people have the wrong understanding of that word. They don't really understand ecosystem, or they conflate it with community. Do either of you see those as one and the same, or what's the differentiating factor as how us as real estate developers or innovators contribute to those?
Do you want to hit that first, Ryan?
A little bit, because I kind of like what you said about, people conflating it. And I almost want to say, like, we need to conflate it in reality, in that a community needs to be seen as an ecosystem, and they don't exist as ecosystems today. We've largely compartmentalized things and siloed things, in that, it was okay to have the city here and the bedroom community there, right? And more we're starting to realize that we need to be thinking of the ecosystem that exists in a community. We need to enhance and amplify that ecosystem. We need to identify its strengths and its weaknesses and figure out how that ecosystem exists among its surrounding ecosystems and where those interplays are. And so I think you're right in that, there's a lot of, especially like on the web, when we talk, especially Web3, when we talk about these different communities and groups and talking about their ecosystem, it's not really an ecosystem. It's a community maybe of networked people, but it's not really an ecosystem in that it doesn't allow for the full cycle, right? Like, those communities aren't dealing with housing. Those communities aren't dealing with all the different intersections of a community. They're a social community, and they're bonding around a particular topic or belief system, but they're not necessarily a real ecosystem. And so that's where I think there's definitely a lot to be learned in how we use language sometimes. I never really liked the term social distancing. You need to physical distance, but we need to all socially get better connected and learn how to communicate with each other. And so, I don't like it sometimes when certain words, like you say, get sort of mixed into the wrong places and we start to use a term a little outside of its definition. And it's okay to be creative. But when you're talking about things like that are really important foundationally to how we all live, work, and operate with each other, it is important that we start to understand what it really means and to treat something like an ecosystem as a holistic thing that we think about when we talk about solving problems and building things.
And so siloing off or, compartmentalizing certain disciplines so that we can study them or that we can frame careers around them, develop careers around them, isn't a bad thing. But life doesn't occur in silos, right? And almost everything that is top of mind for every citizen of not just the United States, but the globe, right? Housing issues, equality, financial equality issues, infrastructure issues, environmental issues, all of these in the first place, we all need to agree that these are complex. They work within a complex adaptive system, right? And it's the orchestration of multiple layers of complex adaptive systems. This means that they're not complicated per se. You can break them down into some really fundamental and easy to understand components, but all of these components are constantly interacting in the world of reality. And part of the challenge in trying to solve problems is when you have all these inputs creating the problem, and we start to say, well, if we just did this, right? And I would even say part of it, our need to be social, right, is also a need. We're often infantilizing problem and solutions, right? Well, if we just do this, we can solve all these problems. And if you elect me in the political sphere, this looks like, if you elect me, I'm going to do this. And then all our problems go away, right? And so that's not the way it really works, is it? Right. And so it doesn't mean for those listening and going, well, I'm a developer or I want to be a developer or, I build houses and I hear what you're saying, but I only build houses. I only do this one thing. I'm not saying that you go out and I'm not going out and trying to solve all these facets of the problem of housing as an example or economic development. But what I'm doing is I'm understanding the whole ecosystem. I'm constantly striving, and I'm literally doing this, right, on a weekly basis. I'm trying to get a better understanding all the time for the way this complex adaptive system is interacting, how it's taking shape in front of me. I have a better understanding every day of the part I want to play in solving these issues. And then I go out and I find, as a business leader, I'm finding the people to bring them in, right? My real interest in being a developer is in ownership over the long haul of multiple properties that generate an income for my businesses, and hopefully, I build wealth doing that, right? And that's what I'm personally focused on. But I recognize, hey, if I'm going to build in a downtown a live-work community, a mixed-use redevelopment, what are the things that are going to attract? If I'm attracting young tech and tech-enabled entrepreneurs, what are the things that they need besides the roof over their head? And who and how do we make sure that we have those types of things in or around the building? And when we do that, they can stay longer. We also try to, this year in particular, we're going to really start in earnest to try to do some unique things with some of these projects. Can we help our tenants who are renting from us build equity over time that allows them to either buy the unit that we've created that they're actually living in now, or some other unit of housing, a different mode of housing that many years from now we might be able to offer them, right? So, if we're back here 40 years from now and I'm 90, well, what did you do? What is it, the thing that you're going to be known for? Well, I don't need to be known for it, but I do want the world to understand that there's these what used to be novel financial models around the way we provided housing and commercial space for people that are now commonplace, that people said maybe 40 years ago were impossible. And in the current financial climate we're in, which was designed more or less after World War II to respond to needs at that time, did a great job doing that. It's not working anymore, right? Well, if we can all be known as the guys who contributed along with millions of other guys to actually, change that, make those substantive changes, that would be great.
One of the things that I think would add some real world application, I can actually think of 2 real estate developers who obeyed the laws of ecosystem building and community and real estate development they've just described, and then another one that has transgressed against that. And the real estate developer that focused on affordable housing, but then they also asked the question, what do our tenants need in order to live here successfully? And how do we blend this into the community so that it's not just a piece in the community, but it's actually an ecosystem, right? And that's sort of how I imagine the definitions of those 2 words. You can have a community, you live near someone, but if you're interacting with them successfully, it becomes more of an ecosystem. And the developer was then working with the school districts and with food banks and providing clothing to tenants if they needed it, or social services, so that this actually thrived and they were successful. And they've been able to recreate that model a couple times, and it's attracted capital because people know that these tenants are cared for, that the developments themselves are successful, and that it's a net positive to the community. Second real estate developer got a bid on a piece of land and or an RFP, and then they just started building. And it's supposed to be this massive, luxurious real estate development that uses new cutting edge technologies, and they had very little consideration for the demographics, the people, the public reception of this, and how they were fitting into the grander picture of the city that they were building in. And this has caused so many problems, down to actually equity financing. People say, well, I'm not investing in this. I don't think it's going to be successful. It's not going to get rented out. The building next door, which was already developed but struggling, it was supposed to be stabilized by now, a year and a half in the making, and it's sitting at 40% occupancy. And you're going to build something even bigger, more expensive right next to that, and expect it to be successful. We're not investing into it. And even the lender said the same thing. We can barely support this, and if we do, we're going to give you egregious terms. And so there's clearly a benefit to abiding by the laws of an ecosystem, or understanding what people, what the community, what's the people who live in that community who move money are thinking about and what they care about, or transgressing that. And I think, as unorthodox as it is to talk about ecosystem in a real estate development practice conversation, it's very important, because you're not just putting a building on a piece of land. That's the outdated model. You're part of something bigger.
And part of that is there are very few businesses left anywhere in the United States that are high net margin businesses. I can think of only a few. Captive insurance is one. Financial services in general, some financial services, landfill management, and waste hauling. If you are in a business that nobody cares, as long as you take the stuff away, you can charge virtually anything you want, right? High net margin. So part of this is, virtually all business in America needs to be more intentionally managed and smarter about every penny, because it just doesn't have the net margins anymore. There's very little you can sell to somebody and make a 300% net margin after expenses, payroll, and everything else. Mm-hmm. So part of it's that. You just described 2 great examples, but they all, I listened to not some of the characteristics you're describing on each one, but all. So holistically, I hear that. And what does it boil down to? It's a very simple business fundamental. Is it market responsive, right? Now we can talk about all the vagaries of, the missing middle, right? We because of the way we finance single unit or multi-unit housing in America, because of zoning and ordinance issues, because of a whole host of things outside in the ecosystem, we basically have created this missing middle, right? All your middle market, middle class housing, it doesn't matter who it's for, age-wise or whatever, It's starter homes. It's senior living for the middle market, right? We have a glut of luxury building that even continues, right? Because if you're rich enough, you have the cash. Hey, have at it, right? Or capital A affordable, right? That's subsidized by state and federal agencies, mostly federal to begin with. And then it's that missing middle that we're not financing. But at the end of the day, all that aside, right? If you know your marketplace, and the housing market isn't a market. It isn't the housing market. It's thousands of micro markets, right? This explains why people in Austin will say, the problem of corporate, and private equity firms coming in and buying up all the housing and driving up the prices is a real problem. Because yes, in Austin, maybe it is, right? But it's not in Rutland, Vermont, where I live, right? So is it a problem there? It's a huge problem in your market, but it's like, it doesn't happen here, right? Because I'm not going to say nobody wants to be in Rutland, Vermont. I moved here, but yeah, we don't have that problem. Is what I'm building responding to the market here. The senior living space that I'm relatively new to with Heartland America, the unique community development part of that financial plan is our faith-sponsored model. But after the faith-sponsored model part is taken out, we do everything the way that most other successful developers do. We use market studies and we take them seriously. We might have multiple studies that we look at, right? That so that we're sort of triangulating on the story and the breakdown of what we want to do. The company's been around for 35 years before I joined. They have learned a lot about what they're good at, what they're not good at, or maybe put another way, what they want to do and be competent at, and some of the things that they just don't want to do, right? They know their place in the market. They want to be innovative in certain ways, and they want to be very traditional in others. And so there's definition around what we do, which allows the organization to create consistency, right? And some modicum of predictability. Even as we focus on this, the faith-sponsored model at the end of the day is about taking a significant portion of our operating capital after we've paid off investors and debt and so forth. And we're using that money strategically to ensure that clients will never have to leave. They can live from, independent living all through memory care, end of life, and not have to leave due to financial circumstances. That's a response to the marketplace and to what we know is coming in the future, which is a significant portion of middle-class seniors are going to outlive their savings. It's already happening, and it's only going to get worse over the next, say, 20 to 30 years, right? There's going to be a bell curve on that of a high number of people, because that's, I should have mentioned, that's also our market. Our market is the middle class. It's a lot harder space to be in. It's a lot harder to make money in that space. Is it possible? Yes. Does it take 30 years to figure that out? It took these guys that, but they, managed to more or less figure it out. So I think I've more than answered your question, and now I'm just going off into space, man. I'm just riffing here like a jazz musician. So you gotta rein me in, Matt Schneider.
Well, the way I want to do that is giving the microphone to Ryan for just a moment.
There you go. That's a smart move.
And sharing, or at least really doubling down on the margin component, because Scott, you said something that I didn't know, which is that captive insurance remains high margin. And I mean, that seems to be a big driver. The amount of margin that you have on an industry determines your technological innovation or your risk taking and how you perceive ecosystem and leaning into that, how well you harmonize. I mean, Ryan, what does it look like on the captive insurance side of things for all of these elements?
Well, it's interesting. So, finance and insurance is high margin. That's where a lot of our GDP exists in this country. And captive insurance specifically is sort of carving that out of the commercial market in some cases and internalizing it, right? So if a very wealthy company, this is, most captives are sole owned, primary captives. And what they're doing is they're saying, we don't want to pay for the inefficiency of a big, huge company. We don't want to pay for the profits of the shareholders in that company. We want to internalize those profits. And so by streamlining the claims management and doing those things internally and having direct access to the data that they need internally in order to process all that information, they're carving that profit back into their company. And so for the state, the captive management business, it's only 21 companies, but those companies provide the management and feasibility studies and help guide them to the lawyers that they need, the other insurance reinsurers that they need. So, one part of captive insurance is you're still going to need some portion of your insurance covered by a traditional insurer, but you can essentially take a very large deductible model and then internalize that deductible, pay premiums into yourself to cover what that deductible is supposed to be covering, and then internalize that profit. And now that profit doesn't just go straight to the company. That profit sits in there and can eventually be taken out as dividends and directed in certain ways, but they're still kind of tied to be directed in the purpose of that captive. So, if they're covering workers' compensation, they're going to be incentivized to spend some of that profit on hard hats and steel-toed boots and safety education for their employees, right? If it's driving toward property insurance, well, that profit might be spun off as a dividend to buy another piece of property, or maybe to help cover the initial cost of investing in a higher cost material that has a longer term benefit to reduce their overall risk of structural damage or deterioration. So those areas represent opportunity. And so it's sort of carving out of an already, relatively high margin industry sector and internalizing that. And in the process, again, for a small state like Vermont, the work hours of the high, right, the attorneys, the managers, those are high paid professions, right? And so a lot of what goes into the industry in terms of actual doing business is the labor hours of those people from those different areas that do the feasibility studies, that do the legal work, that do the management work, the service providers that provide sometimes data solutions that help these captives run efficiently. And all of that is money spent here in the state when they come here to have their annual meetings and attend the conferences, as well as taxes and fees that they pay into the state for operating their entity here. And so while it's not huge for the size of our state, it's a significantly impactful amount of money. I think the 2023 stat was something like $32 million went to the state general fund as a result of the captive insurance industry here. So in another state, that might not be as impactful, but in a rural place like this, it's very impactful.
But to Matt's point, to the question too, further, I'd add, captive insurance is heavily managed, right? In other words, it's good risk taking, which is what makes it a relatively high net margin space, especially within insurance. If you can imagine, the self-insured larger corporations and what have you, there isn't a devastating fire every day, okay, at a large corporation. Unfortunately, an outstanding example of this would be 9/11. When 9/11 happened, the hit that the insurance industry took was simply because in most insurance, we actually focus on the risks that are the most likely to happen, right? And there are risks that are most likely to happen. The absolute worst case scenario is very rare. What we saw on 9/11 from an insurance standpoint is the rare case where the worst case scenario actually, did happen, right? Planes hitting buildings is not common, right? But it's more common than planes hitting buildings and the entirety of the building comes down, right? It almost never happens. And even in a world where very complex buildings like that, where there's, multiple umbrella policies and then there's captive on top of that, right? To properly, how does one properly insure a, 80 or 100, story building? But when the worst happened, there was no level of insurance that could fully cover that. That was the reality, right? And that's why whole insurance companies, dozens of them, went out of business overnight. Those companies weren't necessarily companies with thousands of people working for them. They were, members of the captive insurance segment, right, that were providing all those umbrella policies on top of standard insurance, that those policies just ceased to exist because the worst case in fact happened. That usually doesn't happen. So after this management that happens that Ryan's describing, they're extremely profitable. They're not always paying. It's pretty rare where they're paying out major claims.
Right. There's a natural correlation between risk and the amount of margin. And in the case of insurance, it's a small risk of something going terribly wrong that could lead to the bankruptcy of companies, but generally it doesn't happen. And so they can collect their premiums.
Right. And so here it is in Vermont, right? The bottom line is, for the listeners that need it in plain English, which we always like to be handy for people to really just, there's a lot of this money and it's parked in legal entities domiciled in Vermont. And so the question becomes, how can that be leveraged in ways that enhance the rural economy that we have here? And so there's potential there.
Right. And that was a twofold question that I was wanted to lean into, and kind of circling back to the original margins. You're talking about an industry that doesn't have a lot of margin, and then here you have insurance. Well, that's great that there's lots of money going around, but where is it going? How do we circulate that back into the local economy and then fundamentally the community? So Ryan, in your perspective, you kind of touched on it, but what are some of the ways or more ways that could be encouraged for something like captive insurance to then, well, if I say trickle down, usually that means that it doesn't trickle down, right? That's the irony of that statement. But how can we disseminate that back into the community?
Well, I think part of it is looking at these innovative technologies of all different kinds. Even just talking about cybersecurity insurance, that's a big challenge to address right now. And while we're trying to figure out how to address cybersecurity insurance, we're also inventing technologies that help with cybersecurity. So there's that gap between the real risk and the perceived risk. And that's where a lot of that margin lies. And that's where there's opportunity, not just for the running of captives, but for the servicing of captives, of breaking ground in proving out a model, of creating not just a contract that addresses the financial costs of a risk, but a contract combined with a service that provides either mitigation or complete disintermediation of the risk. And so if you can have a cybersecurity service tied with an insurance product, then you can potentially eliminate a lot of that risk. And in the initial period of time of typically years, proving that out to be true, that's where the profit is. And so that can have a benefit in the rural state of Vermont by simply bringing that business here and bringing that activity here in that sector. But it also has that broader effect worldwide where, hey, if we're mitigating risk, that means companies are being more profitable because they're not having to pay out for losses. And even if those companies aren't doing business with captive insurance here, maybe they're just observing the tools being used and going, hey, you know what? I'm comfortable not insuring because I'm engaging with these tools to protect myself, or I can get the minimum insurance for whatever it is I'm doing. And that overall is a broader interplay between the technology evolution and the use of this sector, this marketplace, this sort of business model of addressing, assessing risk, creating the financial models around it, and then ultimately mitigating those risks with good, smart technology and behaviors.
Right. I want to connect some dots for the listeners, because we have Scott talking about real estate, Ryan, you're talking about insurance. Building talks about both. And there's one thing that contributes to that, and it's the presence of data, and data can mitigate risk, which has a major influence on both of these elements. And then, of course, there's the insuring of the real estates and where this money then goes. One of the ways that building likes to de-risk is not just the presence of data, but verifiable data using decentralized ledgers. So, Ryan, where do you see blockchain playing into the captive insurance market? How could it benefit it? And then for a real estate developer like Scott, how do you see him getting something out of this?
Yeah, absolutely. Well, I think, blockchain helps reduce the friction of actually sharing that data, making it accessible to different parties, between the people that need to do the research for the feasibility studies to the regulators that need to oversee and ensure that those models are being adhered to. And I'll read right from the Vermont Captive Insurance Association website on this. Specifically for construction, there's plenty of projects that might be great projects, great ideas, but if they can't get insurance, they can't get built, right? Even you get financed, you still need to be able to insure the project in order to get it moving. And construction companies operate in a high risk environment, whether you're talking about structural or human risk. And with project specific challenges, captive insurance allows contractors to develop a flexible risk management strategy that adapts to different project types, geographic regions, and specialized work conditions, providing targeted protection and potentially returning underwriting profits. So it opens that door where you might not be able to get insurance from a company that says, we're not going to insure all that. You can come back to them and say, hey, just insure 10% of it. We'll cover the rest of the 90% within this other model. That can break ground. That can open the doorway to progress.
Oh, I guess it's my turn.
Well, Mr. Builder.
Yeah, you've heard us in conversation before, Matt, talk about what comes first, right? Does blockchain and crypto does it need to become more legitimate so that it's more seen as a tool for developers, or is it the idea that more widespread adoption by developers legitimizes it in the marketplace? I think that all tools, I'm personally interested in looking at this as a legitimate tool, right? As a form of financing projects. And I don't think that's rare, but it's certainly there's far less of us that are emerging now as I seem to find myself, sort of going from an entrepreneur who wants to be a developer to, working as an established developer and beginning to have a track record, to say, this is a great alternative means. Groups of people that normally wouldn't be investors but are highly interested in being investors in real estate, this might open the door for them. But we've also talked about, almost all, if not all, of the limitations in real estate investment on the part of investors and how they interact with you apply just simply because it's a digitized or a tokenized form of money doesn't mean that those things change, right? But I see potential with it. Ryan and I and our good friend Will, that are part of our sister podcast Innovato 2, have been talking about it because, and it's also my personal feeling that widespread adoption, and for me that means governments that say here's an accepted form of currency, will do two things. I think it creates more flexibility for people to have access to wealth building, but I also think that a lot of the Wild West within crypto goes away simply because it becomes accepted practice. And I think as far as the technology goes, because of blockchain technology, I think that this form of digital, separate from that, digital banking becomes a lot more secure because blockchain is a superior technology for that, as opposed to what we do now, which I'll let Ryan critique the way I'm talking, but it's almost like we live in this hybrid world, right? Where all the bad aspects of, digital banking and all the bad aspects, I'm talking from a security standpoint, of non-digital banking are in fact the model that we currently, that services all banking. So how about we get rid of that? At the same time, we just say, hey, this is an accepted, as soon as everybody accepts something as a practice, it legitimizes it, right? And the crooks go away, because why would I want to be, crooks don't like daylight, right? Put some lights on the parking lot. This is basically what it boils down to, right?
Yeah. Yeah. I mean, to kind of further the point, right? The financial stack around property development, um, let's just face it, there is fraud, waste, and abuse today, right? I don't think anybody lives in a town or at least adjacent to a town that hasn't had some kind of embezzlement or fraud, waste, and abuse of how the money gets spent on some building project. And at the end of the day, there's all kinds of those that we haven't learned about yet, right? And oftentimes when we are learning about them, we're learning about them years or decades later. And that's where these technologies come into play, is if we can virtually eliminate the fraud, waste, and abuse because the systems of accountability are in place in how we are spending the money, buying the materials, deploying the materials, employing the labor, building the solutions, building the buildings, then all of that savings becomes reinvested, right? It reduces the overall risk. It loosens up investors to invest, whether they're small crowd funds because a bunch of people think something's a good idea, or it's a big institutional investor. At the end of the day, all that money flows a lot more easily when people can trust where it's flowing to and what it's flowing through. And so that's where I see all of these different things interplaying, and the risk mitigation or the risk addressing the risk is a key factor in getting over that hump of adoption and acceptance. And then actually doing it on the ground and proving it out over some time is where we start to really, get some traction.
Yeah, I think that's the point to hammer home the idea that if you have increased transparency about expenditures and just basic feasibility planning in the first place, right? Let's make sure that we come to this with a good plan, and then we're executing that according to the plan, and it's transparent. That reduces the overall risk, and therefore, whether it's insurance, maybe the initial premiums, or what's saved after the fact, or the removal of cost overruns in the project, and so that it actually becomes successful at some point, that's what we're encouraging throughout all of this. And that's why I think that's the captive insurance conversation adjacent to real estate development is maybe unexpected, but it's very relevant because there's a direct correlation just on the basis of risk and carefully watching where all of those dollars go. Right. I want to ask, in your estimate, how far away in terms of years are we from seeing some tokenized formats or blockchain-based exchange of either the captive insurance policies or the capital that goes into that?
Well, for one thing, I got to say it's a very private industry, right? And so I would suspect it's already happening. I remember in 2017, I was speaking with an individual that was talking about their use of blockchain in a food supply chain application, and they were citing activity since 2014 that they'd been using this tool. And my suspicion is that it's partially because they were running their own captive. That's why they had a relationship with Vermont and why I met them here. And they were insuring their own risks, and they were leveraging the benefits of blockchain to disintermediate the relationship between their suppliers, their vendors, their transporters, and ensure that food was moved safely and tests were done and all of those things happen. But that's not in the news, right? There was no token around that necessarily. Now, granted, there was some tokenization in the process in terms of their items were tokenized, the transactions are tokenized, but not tokenized in the sense of, oh, we're selling a crypto to the market, right, to make money on this. They were saving money and making money internally by being more profitable business. And so I would say it's probably already happening. The extent to which it becomes really mainstream is definitely yet to be seen. And so that means it's going to take time to generate the data to fulfill the actuarial tables for, even if one or two companies are doing this, for them to be willing to share that data. And then for other companies to go, oh yeah, maybe we'll do that too. Right. And kind of like, I think you mentioned it, in another conversation about how it's, big companies will, you'll hear nothing from them for a long time. And then they make a big announcement about how they're doing this thing with blockchain or this thing with Bitcoin or this thing with crypto. And I think that's where we're at, is we're kind of, there's a lot of hype in the market in general about what this can do, what's happening with the government. But the reality is it's been being used, and it's going to take a little bit of time for some ground to be broken by the blockchain operators and players to really get active, recognize the opportunity to do their business, to build their functions, their smart contracts, their operations within Captive. And then that will become a standard, a norm, as it sort of proves itself out. Now, they're not all going to succeed. They're not all going to prove themselves right. But I do think that there are some really significant opportunities to address the actual risks within the blockchain industry that need to be addressed. And that will need to happen within Captive. And then that will start to open the door to applying those use cases across other industries and start to really bridge that gap and make it a lot more ubiquitous.
It seems like a portion of that is creating some sort of incentive for these players to contribute their data into the ecosystem is sort of the way that I'm interpreting it. And we look at the same thing in real estate as well, where there's a lot of privacy and intellectual property that exists, and not everyone wants to reveal that data. And so using tokenized financial instruments or new software tools or new ways to utilize that data for efficiency, this has become a big part of our model, where they don't have to keep everything behind closed doors because there's a greater opportunity waiting for them on the other side of that technology, whether it's better valuations, better policies, more capital being attracted to them.
The other factor is a little bit that, in this space, these companies that are operating, a lot of their approvals, their feasibility, it's sort of, it's all built on history. And so to a certain extent, they're all a little reticent to jump in and be a first mover, right? And so what I think I see happening is blockchain companies are going to come into the mix, and they're going to create the opportunity for those other companies to participate in new first moving entities. And that will allow them to prove out a particular use case without necessarily risking their individual 20-year history of success operating their managed Captive. And so I think that's the piece is, some less risk aversion needs to enter the market. Some folks that are ready and willing that feel they understand the technology, that they're confident in moving forward with it, to create that opportunity for the other bigger players to participate in that with some separation between what they're doing day to day. So they're not going to put their whole real estate pool in, right? But they might go, you know what? We got this one project. This developer is open to it. We're going to make the introduction and have them join this new entity that's going to take all the risk. And so if they crash and burn, the old guys are sitting back going, we're good. That was their fault, right? But if they succeed, then they can go to their bosses and say, hey, we think this might make sense. Maybe we should start doing it ourselves.
One of the things that touches upon, and that I'd like to see, I don't know for certain that blockchain as a technology would solve this problem, but I do think I suspect it would influence it. And one thing we need to have influenced and need to change within real estate, I think, is a lot more widespread emphasis on the data-driven side of doing things, making decisions, the what, where, why, and how of what we're going to build, and less on culture and on gut. It's not surprising if you spend even a nominal amount of time in real estate. Lots of people love statistics, and they love to throw the data-driven approach in front of you, and they take it all in. And then they do what they're going to do anyways, because we love passion projects. And I'm not saying somebody's going to call into your show, Matt, later and say, he said, I invested in my hometown because that's what made sense. And we made it work. Now, I get that, right? I totally get it. Wherever you are right now, Mr. and Mrs. America. You should invest in your place. And if you do, and you do it in a smart way, you're going to benefit not only yourself, but your entire community. That said, so much of real estate with people that have the money to be dangerous is passion projects, right? The data tells them this is what my local marketplace needs, and I'm going to do what I want anyways because I have the money. And so I think we need to get away from that, especially when you don't actually have all the money yourself and you make decisions like that at different, parts of your pro forma or your design, and they're not fully market. You're not being fully responsible to the people who have given you money when you do that. When hubris starts to, this is the way we've always done it. I'd like to see us get away from that. And I think I think we have better returns for our investors if we just in every way we possibly can be the most market oriented that we can. Respond to the needs of the people buying from you. Period.
Those are really good points. So we're sort of top of hour here. And so I want to move us into some closing remarks. Scott, I want to start with you. You've got a lot of opinions on trends happening within entrepreneurship, ecosystem, community, and real estate development, and you're living it out, right? We were talking before about the different things going through your mind as you adopt technology, and we've even explored it here. What use cases need to be present or incentives? What do you think that using your development firm as a sample size of many real estate developers in the country, what do you think is coming across the minds of these developers as they look at new technologies, and what trend comes out of that?
I guess it might be roughly split between those that wish to use various technologies to continue to extract as much as they can. And then there's those that want to build based on market responsiveness even more so than they already are. And you know what? There's probably plenty of camps in between that. But I think not just in real estate development, but all business, we need to get away from the extraction economy as much as possible, because even if you were extracting and you made the most money you possibly can, we're increasingly getting to a point in society where that kind of extractive or predatory business models are starting to have social consequences that we're all going to regret, right? Mm-hmm. I mean, what good is me making alls the money on my island if we're down to the last tree and everybody has killed each other, right? I mean, like that kind of a mentality, right? Yeah, I mean, where am I going to spend my money and who am I going to spend it with? I think that I do not have all the answers, and I do not know that I'm going to win by the time I'm not on this earth any longer, but it is absolutely rewarding. And you need to use a tremendous amount of your intellect and pull data from a variety of different sources. It's good, hard, but good work to do to try to be, we've said it here, as market responsive as possible, and stick to your ideas on good community development. And it's just rewarding. So there it is.
Yeah, and I guess from my perspective, do you want me to answer that same question, or?
Sure.
I mean, just to touch on like the democratization, right? I think that, on the one hand, there's a lot of talk about democratizing equity and capital, and I think there's value there, and I think we need to have the gates open for that. But even, to the point of understanding the community, democratizing the conversation, right? It's the status quo or the hubris of whoever's making the decisions that leads to those poor results. And so the more that we can open doorways for the participation in that process, for the communication around what a community needs, for the academic process of learning about a community, learning about its history, learning about the people that are there, the people that are coming there, the people that are leaving and why, the more we can open up that decision-making process to land on better outcomes. And I think I believe that's true. I think I've observed it in some cases, but I think I've observed the counterpoint to that more. And I have some belief that, opening up that conversation will lead to better outcomes.
Awesome. Awesome. Well, guys, to finish us out, if you want to briefly offer what 2025 has in store with you, how people can get in touch to join you on that journey.
Yeah, I'll say first. So folks can get a kind of brief glimpse about Web3 and Vermont and some of my thoughts at interchainvt.com. From that website, there's a number of other links out to other media and partnerships that I've been working on to help support knowledge and education and community. And LinkedIn is where I'm at. So that's a good place for folks to connect. And at interchain.live, you'll find this podcast, our podcast, the Innovato 2 podcast, and always looking for more collaborators there. So continuing the conversation there on YouTube.
Absolutely.
You can always find me on LinkedIn. My web address for the company is smgravesassociates.com. And I'm co-host with Ryan of the Innovato 2 podcast. You can also find our podcast focused on economics, urbanism, and culture. That's called the Are We Here Yet podcast. And look forward to hearing from folks. Reach out. Let's hear from you.
Yeah, awesome. Well, it sounds like there's a lot of educational opportunities and maybe some ways to work together, especially on the use cases, finding new ways to apply the technology, being successful in it, and turning a lot of the theory into practice and actually instigating all the change that we want to see. So Ryan, Scott, thank you so much for coming on the show. It's been a very unique and insightful conversation.
Thanks for having us.
Yeah, thank you. Thank you, Matt.
Absolutely, gentlemen. Take care now.